Welcome, everyone. Thank you for joining us. Today's topic is intentionally provocative. The next 10 years won't reward the same founders the last 10 did. This isn't about criticizing the last cycle. It's about understanding that capital regimes change. And when they do, the founder skill premium changes with them. And if you're allocating capital, that matters. Jean-Marc and Gina are excited to unpack this. Let's start with a thought experiment. If you had to allocate capital for the next decade, and you could only back one archetype, who are you choosing? The growth hacker or the systems builder? No hedging. One choice. Jean-Marc?
10 years ago, growth hacker. Today, systems builder.
Same, but I think we need to explain why that answer changed.
From roughly 2015 to 2021, we were operating in a historically unusual environment. Capital was cheap, liquidity was abundant, risk tolerance was high. When money costs almost nothing, speed becomes the dominant advantage. You could expand aggressively, hire ahead of revenue, subsidize users, raise before efficiency mattered, and markets rewarded it.
And importantly, mistakes were survivable. If you built infrastructure too late, if compliance was reactive, if margins were thin, you could raise again and patch it. That safety net-shaped behavior.
So the playbook was clear.
Raise fast, spend aggressively, capture land, outpace competitors. Efficiency could wait. If you grew fast enough, you'd either IPO, get acquired, or raise at a higher valuation. Velocity itself was defensible.
But velocity without structure creates operational debt. And operational debt compounds, just like financial debt. The difference is, operational debt is invisible until it isn't.
So what changed?
3 big shifts. First, capital became expensive. Second, regulation intensified. And third, infrastructure complexity exploded, especially with AI. CAC rose. Cloud costs surged. Data governance became mandatory. Growth didn't disappear, but tolerance for fragility did.
The environment shifted faster than founder behavior, and markets repriced accordingly.
Multiples compressed dramatically after 2021, but here's the nuance. They didn't compress evenly. Companies with strong retention, infrastructure control, margin discipline, regulatory preparedness compressed less. Why? Because risk got priced in. Investors stopped asking, how big can this get? And started asking, how exposed is this?
Before we move further into theory, let's ground this in data. Jean-Marc, walk us through what this shows.
What you're looking at is 2 lines moving in opposite directions. The line represents the 10-year Treasury yield. The bars represent total venture funding. From 2015 through 2021, rates were historically low. During that same period, venture funding surged to record highs. That relationship is not coincidental. Cheap capital creates risk tolerance. Risk tolerance fuels venture velocity. When rates rose sharply in 2022 and beyond, venture funding contracted just as sharply. This is the capital regime shift.
So you're saying this wasn't founder behavior changing first? It was capital availability changing?
Exactly. Founders optimized for the environment they were given. When capital is abundant and inexpensive, speed is rational. When capital becomes scarce and expensive, efficiency becomes rational. The market didn't suddenly become wiser. It became constrained.
And what's important here is that infrastructure complexity increased at the same time rates rose. So founders now face more expensive capital and more expensive operations. That combination fundamentally changes what gets rewarded.
Founder skill premiums follow capital regimes.
Last cycle, revenue could hide fragility. This cycle, diligence goes deeper. Investors are modeling. Burn multiple, customer concentration, vendor dependency, compliance risk, AI model governance, cloud reliance. The iceberg is now part of valuation.
Let's name it clearly. The archetype that thrived in 2016 is not the archetype thriving in 2026.
2016 rewarded narrative builders, category creators, fundraising velocity, market expansion language. 2026 rewards capital allocators, systems thinkers, risk managers, operators. It's not that storytelling disappeared, but storytelling alone is insufficient.
Gina, define the difference operationally.
Growth hackers optimize funnels. Operators optimize survival. Growth hackers ask, how do we acquire faster? Operators ask, how do we retain stronger? Growth hackers think, what's our TAM? Operators think, what breaks at scale? That second question matters more now.
Narrative builders expand perception. Systems architects build durability. Narrative builds valuation temporarily. Architecture protects valuation permanently. And in a constrained capital market, permanence wins.
Let's talk about how efficiency is being priced today. Jean-Marc, this chart is fascinating.
This scatter plot shows burn multiple on the x-axis and valuation multiple on the y-axis. In 2021, the correlation was weak. Companies with high burn multiples were still achieving strong valuations, as long as growth was compelling. Fast forward to 2025, the correlation becomes much stronger. Higher burn now directly correlates with lower valuation multiples. Efficiency is no longer a secondary metric. It's a primary pricing variable.
So, in simple terms,
Burn used to be forgiven. Now it's discounted.
And that changes founder behavior. When founders realize that every incremental dollar burned directly impacts exit multiple, capital allocation becomes strategic, not tactical.
so this isn't just about survival, it's about multiple expansion.
Exactly. Efficiency is now a valuation lever. That's new. Let the audience absorb that before continuing.
Has fundraising skill lost value?
No, but it's no longer the primary signal. The old badge of honor was, we raised 3 rounds in 2 years. Now the badge of honor is, we extended runway without dilution. Capital efficiency now directly impacts multiple. Burn multiple correlates to valuation compression. That's new.
We saw many companies expand geographically before stabilizing infrastructure. Multiple countries, multiple compliance regimes, multiple payment rails, and they layered complexity on unstable foundations. Today, investors ask, is expansion layered on architecture or chaos? Durability scales, chaos multiplies.
Let's pivot to AI.
The first AI wave rewarded demos. The second wave will reward governance, explainability, audit logs, bias mitigation, cost control, regulatory alignment. Black box AI trades at a discount in regulated industries. Governed AI commands premium. That's a structural shift.
Modern companies are stacks, front end, API integrations, cloud vendors, identity layers, compliance systems. If one layer fails, scale magnifies impact. Founders who understand stack fragility will outperform founders who ignore it.
In healthcare, fintech, energy, logistics, you cannot fake operational maturity. Regulation forces discipline, which is why capital is rotating toward high-friction sectors again, because friction creates moats.
Let's say it plainly. Boring is back.
Predictable revenue, high switching costs, embedded compliance, low churn. These companies don't spike 5 times in 12 months, but they also don't collapse 70%. Investors increasingly prefer compression resistance. Capital is quietly shifting toward infrastructure layers, embedded finance, identity systems, vertical SaaS, compliance tech, and AI governance. These aren't flashy categories, but they are durable ones.
Now let's talk about category resilience. What happened across sectors when the repricing began?
This chart tracks EV to revenue multiples across 4 categories: consumer tech, horizontal SaaS, infrastructure SaaS, vertical SaaS. All categories peaked in 2021. But notice what happens during compression. Infrastructure and vertical SaaS decline less severely, and they stabilize faster. Why? Because these companies often have higher switching costs, embedded compliance, operational depth, mission-critical positioning. Their revenue is harder to displace.
So the market distinguished between surface-level growth and foundational systems?
Precisely. When capital tightened, investors asked which companies are essential and which are optional. Infrastructure tends to be essential.
And essential companies compound quietly. They don't spike as dramatically, but they don't collapse as violently either. Durability compresses less, and it recovers faster.
Foundational layers survive cycles better than front-end narratives.
The founder of 2030 must understand capital structure, risk modeling, regulatory exposure, operational redundancy, and margin engineering, not just product market fit. Founders who treat compliance as strategy, not overhead, will win.
Let's operationalize this for investors. Instead of asking, how big is this market? Ask, how fragile is this revenue? Instead of, how fast are they growing? Ask, how exposed are they to vendor or regulatory shock? Different questions reveal different founders. 2 companies. Company A, 120% growth, negative 40% margin, aggressive expansion. Company B, 45% growth, positive EBITDA, high retention, embedded compliance. In 2021, Company A. In 2030, increasingly, Company B.
Markets reward survivability now, and survivability is engineered, not pitched.
This is not anti-growth. Growth still matters. But growth without structure is now penalized. The next decade rewards builders over promoters, architects over hackers, capital allocators over fundraisers, durability over velocity. That's the shift.
The founders who win the next decade won't necessarily be the fastest. They'll be the ones still standing. And for investors, that changes who you back. Let's open the conversation.
For the past decade, fintech rewarded a very specific kind of founder. The playbook was simple: move fast, raise aggressively, abstract complexity away. Payments became easier, APIs became simpler, money moved faster. And that innovation changed the world. But it also created something else: fragility. Because underneath those beautiful interfaces, the infrastructure of trust didn't evolve at the same speed. Now the environment has changed. Three forces are reshaping the next decade of financial infrastructure. First, regulation is intensifying globally, not gradually, structurally. Payments are no longer just a product challenge. They are a compliance and governance challenge at planetary scale. Second, AI is transforming how financial systems operate. AI can approve transactions, detect fraud, route payments, but when decision-making becomes automated, accountability must become programmable. And third, capital markets have learned a painful lesson. Growth without resilience is expensive. Investors are no longer rewarding speed alone. They're rewarding durability, infrastructure that holds under pressure. Which brings us to the core question for the next decade. What does trust look like in an AI-driven financial system? That's the problem LockTrust was built to solve. LockTrust is building the infrastructure layer where trust is programmable, compliance is automated, and payment systems become AI native and regulation ready by design. That's why LockTrust was recently recognized as a top AI payment solution. Not because AI is a buzzword, but because the next generation of financial infrastructure must combine AI intelligence, regulatory resilience, and global payment trust. The last decade rewarded companies that simplified payments. The next decade will reward the companies that make payments trustworthy at scale, and that's the category LockTrust is building.
Let's start with the question many founders are asking. Is this simply a recurrent reset? When rates fall again, won't we return to growth at all costs? That's the central tension. Are we witnessing a temporary correction or a structural repricing? Jean-Marc, structural or recurring?
I'd say both, but primarily structural. Rates may fall, liquidity may improve, but three forces don't reverse easily: regulatory intensity, infrastructure complexity, and AI governance expectations. Capital may become cheaper, but risk tolerance will not. We're not going back to 2018 psychology.
Founders who built discipline in the cycles won't abandon in the next. Markets have longer memory now.
So even if liquidity loosens, discipline remains. That suggests something deeper than rate sensitivity. Let's push that further. Are we overcorrecting? Could we be underpricing visionary founders? There's always risk in pendulum swings. Gina, are we at risk of undervaluing ambition?
That's a fair concern. Vision still matters, but vision without operational rigor is fragile. The strongest founders now combine narrative clarity and execution discipline. We're not replacing one archetype. We're raising the bar for both.
Investors aren't punishing vision, they're punishing structural weakness.
So the market isn't rejecting vision, it's demanding structural integrity, which leads to a harder question. What do you measure durability in diligence? If durability is the new premium, how do you actually underwrite it?
I'd say with 5 indicators. We've got revenue quality, retention, concentration, and pricing power. 2 would be infrastructure dependency, vendor exposure and control points, regulatory posture, proactive and reactive, burden multiple discipline, and governance maturity. Durability is engineered, it's rarely accidental.
And we assess founder psychology. When under pressure, do they expand or stabilize? That instinct shows up later in scaling decisions.
So durability isn't narrative, it's architectural. And architectural reveals itself under pressure. What founder behavior is now a red flag? This is where it becomes practical. What signals tell you fragility is embedded early?
I'd say 3 signals: expanding before stabilizing, treating compliance as overhead, and confusing fundraising skill with operating strength. Capital efficiency reveals character.
If a founder cannot clearly architect operational risk, that's concerning. Optimism without risk literacy is dangerous, as we've all seen last year. Many of the new fintechs scaled very fast because they received $1 billion in funding just to start, but didn't have the background or the knowledge to put the infrastructure and articulate what was needed.
So optimism isn't the issue. Unexamined optimism is. That distinction matters. Is AI accelerating the shift or distracting from it? AI complicates everything. It is reinforcing discipline or tempting markets back into excess.
Both. AI increases infrastructure complexity, it intensifies regulatory scrutiny, it amplifies operational risk. But it also tempts founders back into demo-driven momentum. The real distinction is this: are you building AI features or AI systems?
AI governance will be a valuation variable within 5 years, not a compliance variable, a valuation variable.
So governance becomes a valuation variable. That's not incremental. That's structural. Does this favor certain industries over others? If discipline compounds, where does it compound the fastest?
Yes, it favors certain industries. High friction industries benefit: healthcare, fintech, energy, industrial technology, infrastructure, software, because discipline is unavoidable. Low barrier industries will struggle to defend multiples without structural depth.
So high friction environments reward preparedness, which suggests durability isn't sector specific, it's structural. Are public markets leading this shift or private markets? Who's actually setting the tone here? Public markets or private underwriting?
Public markets repriced first. Private markets resisted. Now, private markets underwriting assumes exit discipline. IPO windows will reward profitability narratives, not hypergrowth narratives.
So exits now assume durability. That changes how private capital behaves upstream. If allocating fresh capital today, what founder trait matters the most? Let's compress this. One trait: discipline, systems thinking, risk literacy. Those weren't the dominant traits a decade ago. Could discipline reduce innovation? Some founders worry about that. Is rigor a constraint?
Only if misunderstood. Discipline doesn't suppress innovation, it extends its lifespan. Undisciplined innovation collapses under scale. Structured innovation compounds that.
So structure extends innovation's lifespan. That reframes discipline as amplification, not limitation. What will we look back on in 2030 and say we misjudged? Let's end on reflection. What did we underestimate? Jean-Marc?
We may have underestimated how quickly governance becomes competitive advantage.
We may have overestimated the staying power of companies built purely on narrative and funding.
Interesting. We may find that narrative cycles were louder than structural shifts. One sentence each. Who wins the next decade?
Founders who understand capital is no longer forgiving.
Founders who treat infrastructure as strategy.
Not the loudest, not the fastest, but the most structurally prepared. Thank you all for that level of conversation today.
Thank you, everyone.
Thanks, everyone.